When it comes to retirement planning, the 401k plan is often the centerpiece of the conversation. But how do these plans actually work behind the scenes? Let's take a look under the hood, from the rules that shape them, to the roles that keep them running, and the journey each participant goes through. The basics. What is a 401k plan? A 401k plan is named after a section of the Internal Revenue Code, the rule book that governs tax law in the United States. This section allows employees to defer a portion of their income into a retirement account before taxes are taken out. That's the magic, before tax contributions. They reduce your taxable income today while helping you save for the future. The money then grows tax-deferred until you withdraw it later, ideally when you're retired and possibly in a lower tax bracket. Some plans also allow Roth contributions, which are made after taxes. In return, those contributions and their investment earnings can be withdrawn tax-free during retirement if certain conditions are met. Cash or deferred arrangement, also known as CODA. The core feature of a 401k plan is what's called a cash or deferred arrangement, or CODA. Simply put, employees have a choice: take all of their compensation as cash, or defer a portion of it into the plan. It's completely voluntary. The employer can't force anyone to contribute. That decision is always up to the employee. These deferred amounts are often called elective deferrals, since each employee elects how much to defer. Behind the curtain, who keeps the plan running? A 401k plan may seem simple on the surface, but there are many moving parts and people working behind the scenes to keep it compliant, fair, and functioning smoothly. Here are some of the key players. Plan administrators. Often the employer, this role involves hiring legal and financial experts, determining who's eligible to participate, communicating plan changes, and handling regulatory reporting. Record keepers. They maintain accurate records of contributions, account balances, and investment activity. They also help with plan testing and reporting. Service center representatives. These are the support staff who take phone calls and answer questions from employees. Benefit services teams. They provide offline support like document management, quality checks, and processing administrative tasks. Attorneys. They draft legal documents that describe the plan's rules and features. Accountants. They assess the financial health of the plan, but usually don't offer personal financial advice. Actuaries. While more common in pension plans, they sometimes help in areas like plan testing and financial calculations. Trustees and custodians. They're in charge of tracking and investing plan assets, following instructions from administrators and record keepers to manage the money responsibly. And of course, oversight comes from two major agencies, the Internal Revenue Service, IRS, and the Department of Labor, DOL. They regulate the setup and ongoing management of all qualified retirement plans. Filing a claim for benefits. Sometimes disputes happen, maybe about eligibility or how much a participant should receive. In these cases, employees can file a claim using the plan's formal process. Once a claim is filed, the plan has up to 90 days to make a decision, or 180 days if they notify the employee about an extension. If the claim is denied, a written notice must explain why and how to appeal. The employee then has 60 days to file that appeal. The plan has another 60 days to review the appeal, or longer with proper notice. If the appeal is still denied, the plan must provide information on any further appeal options, including the employee's right to take the matter to court. The 401k life cycle, from enrollment to exit. Every participant moves through several stages within a 401k plan, joining the plan. This involves choosing how much to contribute, whether to use traditional or Roth contributions, and where to invest. Managing the money participants can rebalance their investments, change contribution types, or roll over money from another plan. Accessing the money. Some plans offer in-service withdrawals or loans, though there are limits and potential penalties. Exiting the plan. When employees leave the company, they can either take a full distribution, roll the money into another account, or leave it in the plan. However, after a participant leaves the employer and reaches age 70 and a half, they are required by law to begin taking required minimum distributions, or RMDs, each year. And that wraps up the inner workings of a 401k plan. It's more than just a paycheck deduction. It's a structured system with clear rules, responsibilities, and phases. Understanding how your 401k operates empowers you to ask better questions, make more informed decisions, and ultimately take full ownership of your retirement journey. Coming up next, we'll dive deeper into 401k contributions, including annual limits, employer matching, vesting rules, and how to maximize your retirement savings. Until then, keep learning, keep saving, and keep building your financial future.